Good morning, guys. Welcome to Wake Up Wednesday. I'm just kind of happy to be here. Just kind of announced my nonprofit. So as you guys know, I help nonprofits and for-profits with their business funding needs by creating their grant proposals or their business plans and submitting them to funding sources. So what I have recently done though is I am about to start a group. So I own two businesses, well, a couple of businesses, and I'm going to be helping some young women between the ages of 18 and 24 get into the financial services industry. As you know, I used to work at a few banks, and so if you have any daughters that you would like to get mentored and go through my program, after the program, they will be able to get into a financial services job and earn money in the financial services industry. So with that being said, I'm actually going to start sharing my screen here. Okay. And just kind of wanted to go over a presentation that I did at another event, just talking about women walking in wealth. So as we know, if you guys know, there's a disparity among women. So a lot of women defer to men for the finances, and that's great. But the problem is sometimes we don't know what is going on. So as we had all of this situations with COVID, there's a lot of people that have been in strain. We had a person at a church. Both parents died of COVID, and they left very young children without a plan. So we gotta get this together. It's time out for not knowing what we're doing, how we're doing it. We have to plan for everything. Plan for the worst case scenario and just outlive the worst case scenario. Because if you do that, everybody's going to be together. And the reason why we want to kind of learn more for women, or if you're a man watching this, just kind of understand women live longer. So my husband's 13 years older than I am. And I was a stay-at-home mom for a while, so I don't have a lot of time in the workforce. So women stay out of the workforce a little bit longer, and men, live a little bit shorter. So if we're not planning for after our mates leave us, we love our mates, we love them, but I know my husband's 13 years older than me. I know he may leave me before I leave. So it's just kind of, we got to kind of try to plan for that. What happens? Who takes care of me? Is there a long-term care policy in place? If is there a long-term care policy in place if something happens to him? You know what I'm saying? So we got to kind of like think about that. This trend is actually, they're saying women 20 to 34 are more likely to leave the money decisions to their spouses. So I used to work at Fifth Third, and one of my clients, she was a lady. She had $1.2 million. It was a client before, I was the one that closed out her account. She wasn't mine prior, but her dad had worked at Ford Motor Company, and she had $1.2 million in one stock. So she didn't have it in multiple different stocks. Her dad loved Ford. He was a diehard Ford fan. When he left her an account with $1.2 million in it, and all it had was Ford stock in it. So as you notice, in 2009, I was working at Fifth Third. As you see, in 2009, we took a big hit. That's when we had to get the bailouts and everything. So her account had an original balance of $1.2 million. It was down to $234,000 when we closed it out. She just couldn't risk, and it came back, but she couldn't stomach, maybe losing all of the value. So basically, that is something that is called a market risk. That's one of the risks that we were talking about. So what you don't know can and will be used against you. So I got this lesson from Mike Wilson. He's one of the senior financial strategist at World Financial Group. And basically, there are 8 risks to your finances. And there's some things that we need to know. Market risk, tax risk, inflation risk, long-term care risk, sequence of return risk, withdrawal rate risk, legislative risk, and longevity risk. So what is that, guys? Well, market risk. Remember my friend that lost all of the money? That is something that's called a market risk. So if you don't have your money in things like indexed universal accounts that are not in the money but indexed, now there's some different things. You gotta know what you have, but there's some indexed annuities that have zero floors that can protect you from a downturn. So everybody that if you want to know if something like these are suitable for you, inbox me, and I can give you a free financial needs analysis. There's a taxation risk as well. Now, this guy here, he was the United States, he was the controller for the United States Government Accountability Office. And he said that our tax could double because the government's spending a lot of money, which right now they really, when he wrote this article a while back, they were spending money and in deficit. Well, now the government is definitely spending money in a deficit, and taxes have never been as low as they are now. So what's going to happen is taxes are most likely going to increase. Now, in U.S. history, we have at some point been taxed 91% of our paychecks, up to 91%. It was recently up to 37%. So that means every dollar, if the tax was 91%, every dollar you made, the government would take 91 cents of it, and you would get 8 cents of it. And up to recently, if you were making enough money, they could take 37 cents out of every dollar that you made. So it's not impossible that it's not impossible. Let me go put that back up there. That taxes would be still there. Let me put this. Oops, gotta stop sharing, guys. I must have went off of my PowerPoint here. Hold on 1 second. All right, so then there's something called an inflation risk. In U.S. history, we have had years of inflation. At some years, we've even had up to 34% of inflation. Right now, it's about 3%. So if you have your money in any bank account that's making less than 3%, you're kind of losing money right now, because the money, even though you're not physically losing it, it is losing value. So we want to kind of keep pace with it. There are some things that you can do. You can outpace inflation. This isn't an actual, for the last 20 years, actual performance of an account that we have, an indexed account that we have, compared to the S&P 500. As you can see, the S&P 500 from 2000 to 2019 averaged about 4%. This index account averaged about 7.54%, 8%. So you can be doing things that can outpace inflation. There's something called a long-term care risk. Guys, if you don't hear me on this, I'm younger than my husband, and this can hit home. My grandma, she had to go through this. She had to go through a spin down, a Medicaid spin down. She had the best insurance products. She bought the highest Medicare plan, but the highest Medicare plan does not cover long-term care. So when she had a stroke, um, the one thing that she had never wanted in her entire life was to just never have to apply for Medicaid. And the insurance that she had been paying on for years paid for 90 days of that 90 days of care, but they don't cover long-term care. So anything past that 90 days had to be covered by either the family or you know you got to get Medicaid. That's the only two things that will cover it: your money or Medicaid, or a long term care plan. So that is specifically for that. And some insurance products have, and some insurance products have riders. So you want to kind of know this, because there are spin down. If you're married, you could be forced to spend down all of your assets to a certain dollar amount. And of course, what happens when, when that spouse is gone, now, of course, you're not in the same situation you were, and you can't leave a legacy for your kids, because it is meant to make sure that all of the assets go to the nursing home and not to your kids, or so that you can leave a legacy if you haven't planned wisely. So that's something that you want to kind of know. Sequence of returns risk means that, what if you had that million in your account, but right before you got ready to retire, it went down to the 234,000, like I told you. Then you might not be able to retire. So you won't be able to, take your money and live in your retirement. So it's very important that you're in accounts that are either protected, have a zero floor, and outpace inflation. Okay. Also, safe withdrawal rates. Let's say you had $1 million in your account and you weren't making 10%, and you wanted to take $100,000 per year. You wouldn't be able to do that, because if you're not making 10%, you're going to be eating into that principal. So if you take $1 million, you start taking 100,000 a year, you only have 10 years. We have to be able to create keep your money, so that you are not having to go to additional other sources outside of yourself to plan for your retirement. So there are some accounts that have lifetime riders on them. There's some things that you can do to protect against withdrawal rate, and then also just calculate the best withdrawal rate based on what you are getting in your account that you have your money in. And then you have those legislative risks. There are 3 times in history that tax treatment on certain accounts have been changed. So the tax treatment was better, and then they got changed for the worse 3 times in history. But those people that had their accounts prior to the change actually got to keep the benefits of the old grandfathered accounts. So, legislative risk is one. Longevity risk, this is one of the ones that really, really, really kind of goes on all of the things that you guys have been doing. If you if you did not take everything serious, you didn't protect your money from downturns in the market, you got taxed because you had everything in taxable accounts. If you put all your money in a 401k, when you retire, everything gets taxed. So let's say you get $100,000, you want $100,000. If you're in a 24% tax bracket, you're going to take out your standard deduction, which is around $24,000 right now. In that $76,000, going to be taxed at the tax rate, the normal tax rate. So you're going to give the government a piece of that. Why would we put all of our money in taxable, completely taxable things for retirement? You can plan to not to have a tax or nearly tax-free retirement. So what if you didn't outplace inflation and now your money's not worth the same thing it was? You had to spend everything on a spouse's long-term care. That's a risk. You lost money right before you started withdrawing for your retirement, and the government changed rules. So now this is what's happened, and you are you don't have any money. So we can plan against these are the risks, and now you know them. So let's not let this this scenario happen. So I kind of did this because, remember guys, I'm opening that nonprofit, and I am going to be mentoring young women 18 to 24 to become financial professionals. Okay. And in this industry, only 9% of women and minorities combined, that means women, white and black, and all other minorities, make up 9% of the workforce of all financial professionals. The other 91% are white males over 55. So I'm a financial professional with World Financial Group, and we're a Trans-American company, which has been a broker, awarded the best broker dealer for females the last 7 years in a row. So, we got all of this stuff. We got a lot of training. So I'm going to be mentoring those youth and to get into the financial services industry. Here's the thing. Wall Street Journal is saying that clients want to work with female advisors, and firms are taking notice. So I definitely would love to get in front of your daughters, have them inbox me, or because we're getting ready to do a interview process for that. But also what is going to happen with that is I am going to have the ladies that graduate that program, I am going to be giving away some red bottom shoes, boss ladies. So they're gonna get a chance to win those red bottom shoes for graduating my program. So if you or your daughters are interested in getting into a field where women make a lot of money, I make over $20,000 a month in financial services, personally myself, outside of my other businesses. So they will be learning from somebody that actually does it, and they will be able to get their money. They'll be able to win those red bottoms. Is this not sharing my screen? Oops. Right, there we go. Oh, I was just going there. So just the red bottoms are there. They're going to be able to win those red bottoms, and they will be able to get mentored by me. Guys, have them. Hey, that's awesome. Okay, thank you, Terrence. Oh, good morning, Dr. Missy. Yes. So again, get your young ladies, get them to interview. I'm going to be starting that program January. It's going to be starting the second week of January. So we're doing interviews now, 18 to 24 young ladies that want to get into the financial services industry. Have them inbox me, share this video so that more people can join that program. All right. Bye, guys.